Hi, everyone. Today we're going to be talking about investing. We're going to be covering chapter 13. We're skipping ahead a little bit because I wanted to make sure that we covered this chapter earlier, simply because it's kind of the foundation for a lot of the other chapters that we cover, a lot of the topics that we cover, and also because we're doing the stock market challenge. And I think it's important for you to kind of have a better mindset, a better perspective, and just kind of learn the basics. This is probably one of the more popular topics and one of the reasons that students take this class because they want to learn about investing, or at least that's the feedback that I've received. And so I wanted to cover it in the middle and kind of build upon that as we move into, the rest of the semester and like I said, the other topics that we cover. Now, investing, a lot of people think about investing as something that you can do. Like there's a specific like recipe that follow and then you become a billionaire or a millionaire. That's the idea behind, I think, the perception behind investing. And this chapter is meant to, and this lecture is meant to sort of break that myth into pieces and help you understand what it really means to invest and how to think about investing. I think for me, like myself, I came from a family that was very low income, came from, I like to say, came from nothing. My parents were immigrants. They came to this country with nothing. And so I grew up with very little. We didn't have a lot of luxuries. And for people like me who kind of have to build the generational wealth from scratch, I think it's a different, perspective and strategy versus someone who maybe has, a trust fund or, maybe they have wealth that's been inherited from different generations. So everyone kind of starts at a different place. But if you've never been exposed to anybody that has had wealth at all, I think it makes it a little bit harder to even have a perspective on it. So my hope is that I can give all of you, no matter where you're starting, a good perspective on investing and just kind of how to set yourself up in the long term, for having a successful future, no matter what that might be. And so, like I said, a lot of people think that there's a formula that you can just say, if you do this, this, and this, you're going to become a billionaire or a millionaire. And the first thing I want to just clarify is that there is no magic recipe. There is no magic, formula that you follow. It is just a matter of, it's a slower process than people imagine. I know there's a lot of hype over things like crypto and different investments that you can make you a millionaire overnight, but that's actually very rare. Most wealth is built over the long term, over the course of someone's lifetime or the course of multiple, families, generations, and things like that. And so I hope that I don't mean to discourage anyone. My point is just that if you do the right things now, especially for those of you that are really young and just starting off, I know sometimes I get high school students that take this class, but the key is starting young and understanding that it's never too late, as long as you have that long-term perspective. So hopefully we can cover a lot of different topics that get you to a good place when it comes to your own investment portfolios. All right, I'm going to share my screen and we'll go ahead and get started. All right, so investing fundamentals. The learning objectives for this chapter, first, we're going to describe why you should have an investment program for yourself. Number two, we're going to look into safety, risk, income growth, and liquidity and how those affect your investment alternatives and your overall investment plan. We're going to talk about the importance of your personal investment program and then how to use various sources of financial information to reduce risks and increase investment returns. And this is really important today, I think, because I don't know if many of you follow different people on social media, whether that's Facebook, Instagram, TikTok, etc. But there's a lot of people out there that create social media accounts dedicated specifically to investing in different types of investment programs and investment vehicles. And it could be crypto, it could be specific stocks, etc. I follow some myself, so I understand. But it's so important to understand where that information is coming from. Is the person actually an expert? Is the person actually qualified to be telling you what to do with your money? And this is actually an industry that's very regulated And social media is kind of like the wild, wild west where everybody can come on there and say whatever they want. And so you have to be really careful with where you get your information. And so that's why I think it's a really important thing to talk about, and especially as you all kind of go out there and follow these accounts and try to figure out what to do with your investments, with your money. It's very important that you understand, like anything else, where that information is coming from. All right, so a lot of people think about investing, like I said, as this shortcut. Like I'm gonna follow this formula and I'm gonna become a millionaire, like a shortcut to riches, as they say, or like hitting the lottery. But that's actually not the reality of how investing works. Yes, you hear about some people becoming millionaires overnight. You do, and there are actual stories. People do win the lottery, people do get lucky and invest in maybe a specific Bitcoin or whatever, and then they become millionaires. But most of us, and including myself, wealth is something that I've been working on building over time. And with those people that do go out there and invest in Bitcoin or invest in whatever it is, whatever crypto or whatever investments you see out there. The thing that you don't hear about is all the people that maybe also did this but lost everything. And the thing about those types of investments where you quote unquote get rich quick is that you are putting yourself maybe in a position where you could make a lot of money, but you are also putting yourself in a position where you could lose everything. And this is the thing that people don't talk about. They only talk about the success stories and how few of them they are. But there's so for every person that you see that maybe did get rich quick or did get rich overnight, um, some of them or many of them lost everything or lost a good chunk of their assets. And the other piece is that for those that do maybe gain the wealth overnight, because they don't know how to manage it, or maybe they stay invested in this particular thing that made them wealthy, then that particular item maybe loses value over time, and then they go back to losing everything. So it's not all doves and roses. And I think that is a myth, and that everybody needs to understand that is not reality. For most of us, we work on building our wealth over time because it's safer, it's not as risky, and it is more, especially for those people that have maybe families and whatnot, it's more realistic in terms of growing, your money. And so, like I said, a lot of us grow it slowly over time. Think of investing as planting a seed, and you water it, you care for it, and have the patience, and over time it grows into something bigger. It's not flashy, but it does work. It takes time, intention, and strategy. So the reality of investing is that it is a long-term endeavor. And so that's the first thing I want to kind of lay the framework here in perspective for you all. Wealth and building wealth takes time. All right. So I think my computer is stuck here. So what exactly is investing for those of us that maybe have an idea of what it is, but think of it as just buying something that grows in value and something that makes some income for you. And so some examples, and remember when I say assets, you're buying something like a stock, a real estate property, maybe a home or a rental property, bonds or mutual funds. These are some examples. And these things are known as assets. So you put your money into these things and you expect it to grow in value, or you expect it to give you some income. So, for example, if you bought, let's say, Tesla stocks, you're buying a portion of the company. This is something that you all purchased for the stock market game. You bought a share of a company, and let's say you buy it for $200. And then 3 years from now, you still have the stock, and now it's worth $900. So you made a profit, and that profit is called a capital gain. And you could also buy a house, and you could buy a rental property. I have rental properties myself, and when the tenants pay rent, that generates income for me. And if I bought the house for $200,000 and in 10 years or 5 years it's worth $300,000, then I will have made money from the gain as it increased in value, and I also make money from the income that it's generating for me every single month. And so those are some examples of how you can grow an asset in value and you can have it generate income for you. So both are forms of investing, but the goal of investing is ultimately to make money for you in some way. And again, going back to the crypto example, you could buy crypto and it might increase in value and it might make you that capital gain. And yes, it is a possibility. But there are, as this list shows here, there are different kinds of assets, different kinds of investments, and each different one has a different level of risk associated with it. It's more volatile in terms of the value. So you have some stocks and some crypto that goes like this. One day you wake up and the values appear, and then the next day you wake up and it drops. And so it goes up and down, and that's completely connected to things like the economy, what sometimes it's what the president says, sometimes it's, what happens. Maybe there's like a big event that happens that, like, for example, COVID. And that all causes assets to change in value. And so the key is if you want to create that stable long-term, wealth, you want to try to put your assets, your money into assets that will generate that long-term growth for you. And when you have a very short time to invest, let's say you want to start investing and you're going to retire in 5 years, well, then that time frame is much shorter. And so the things that you have to invest in change depending on who you are, your age, where you are in life, a lot of different things. And so as you are all developing your own investment portfolios, these are all things that you have to consider because that will help you choose which types of assets you're going to buy with your money to help you build that long-term wealth. All right, so there's the way that I like to share with my students, the way that you can think about wealth. There's three portfolios that you have in your life. You have your portfolio A, portfolio B, and portfolio C. So when you think about who you are as a person and what's going to generate your wealth, you have portfolio A, which is your career, your education, your skills, your network. These are things that will always generate the most wealth in your lifetime. If you get a college degree, that ultimately leads maybe for a double the income that you would have if you didn't have your college degree. Maybe you have a network that connects you to this job that pays you a boatload of money, and those are things, your education, your career, your skills, your network, things that will always are going to generate the most wealth for you. You invest a couple of, depending on where you go to school, you invest a little money in your education, and that pays off, pretty significantly for most people. Then you have portfolio B. This is your traditional investments, your stocks, your bonds, your real estate. And then you have portfolio C, which is kind of the more risky stuff. Maybe you want to buy crypto, maybe you want to invest in your friend's bar, maybe you want to do some day trading. So the A portfolio, like I said, is always going to generate the most investment or the most return on your investment and the most wealth for you. Portfolio B, your goal with that one is it's this traditional investments, right? So your goal with this one is that it should grow steadily over time. And then the portfolio C is your fund money. So this one should always be small because it's risky. So whatever you put in this portfolio, you always have to know that you could potentially lose it all. So keeping that framework helps you balance your risk and your opportunity. So as you're thinking about what to invest in and kind of how much to put in each of your investment buckets, you always want to, we don't want to say don't invest in things that are maybe a little risky. You just have to limit the amount of money that you're putting into it because it is a risky investment. So the last thing you want to do is put all of your money into a portfolio that could potentially lead to you losing everything. So I just want to share this kind of mindset, this perspective on how to think of wealth and how you will build wealth in your lifetime. All right, so as you get ready to invest, there's a couple of things that you want to have. So first, you want to know how to balance your budget, paying your bills on time, how to pay off credit card debt, and having those habits, be working well for you. You want to get this right because a lot of people are like, yeah, I just want to invest, but then they haven't taken care of their house, like in metaphoric way, you want to be able to take care of your house before you are going in and putting your extra money into investments. So the first thing you want to do is make sure that you're paying your bills on time. Make sure that you're reducing your credit card debt because think about it, if you're investing, you're expecting some return. But if you have a credit card payment that's charging you 27% interest, you're paying the credit card company 27% of whatever you owe so that they can let you borrow that money. And that's a lot. That's a 27% return for the company. So they're letting you borrow $1,000 and you're paying them a 27% return to let you borrow the money. So you want to pay that off to make sure that you're getting that return in some way or some level of return from your money, not giving it to someone else. So you want to pay your bills on time, balance your budget, make sure that you're actually reducing credit card debt or eliminating it altogether. And then the other thing you want to do is have an emergency fund. This is a really important part of investing. A lot of people skip this step, but it's so important because we never know what can happen in life. We could have a car accident, maybe an uninsured motorist hits us. We're responsible in some way for a rental car, etc. Our insurance might not always cover. There's health situations that pop up in life. Maybe you need a new car. Maybe you have a baby coming. There's so many things. Maybe you lose your job, right? And so you always want to have an emergency fund. And I always recommend having it in a high yield savings account. It's basically a savings account that filled with money that you set aside for an emergency. And that money should never move. It should always be easily accessible and it should always be available so that you can sleep at night comfortably knowing that you and your family will be taken care of. If for whatever reason something happens, nothing to stress about in terms of money. You have time to find a new job, you have time to pay for these expenses, get yourself out of this hole. Maybe you need new tires, maybe your engine, something happens to your engine with your vehicle. Whatever the case might be, you always have that money set aside for that. And that's a really important part of investing because if you don't have that set aside, you can find yourself in a situation where maybe you don't have the money and your money's invested. And usually, when it's invested in something, it's tied up. It's not as easy to get your money out. It is easy to get it out. It's just if the market happens to be down in that particular day, you don't want to find yourself in a situation where you have to sell when the market is down. You want to wait and have that cushion. And so again, you want to pay your bills on time, get rid of credit card debt, make sure you have your emergency fund, and always be good at balancing your budget. You have to have that strong foundation before you start allocating your extra income into investing. So again, make sure your credit cards are not 25% maxed out. Um, I always recommend paying them off completely, but if you have to have some kind of credit card debt, try to have very little, depending on what your total available credit is, try to make sure that maybe only 25% of it is spent because that helps with your credit score. No investment will pay that amount, so if you're giving the interest rate to the credit card companies, then it's kind of a bad place to be in because you're investing in something, but then paying whatever you're making in that investment to the credit card company in interest. So the goal is to completely eliminate any high debt that you have, whether it's credit card or maybe it's a payday loan, whatever it is, make sure that it is paid off if you can, unless you have the kind of credit card that you're just using and paying off every month. And so again, having your house in order is a very important piece, having the financial foundation before you actually invest. The better you are at this, the less stressful investing is for you because some people have a really hard time with the risky part of investing. And like I said, it could mean that maybe you buy Tesla for $100 or $200. Let's say you buy Tesla for $200 today. And then in 5 years, it becomes 900, right? That's a huge gain. But let's say in the middle of that time frame, maybe your tires, you need new tires or something happens, you get in a car accident and you need to take that money out of your investment in order to pay for this because you don't have an emergency fund. And so let's say that during that time frame that you had the Tesla stock when it was 200 and kind of went up to 900, every day in that window, it goes up and down. Some days it goes down a lot, some days it goes up a lot. So let's say that you need these new tires during a day when Tesla is at $100. You know now that it's going to go up to 900, but if you had to sell it at $100, you would be losing, money on your investment. So you don't want to find yourself in those situations. That's really the key. So the time value of money, we've talked about this before. You know, the the concept is just that money today grows with time. It's one of the most powerful reasons to start investing. Time value of money. The longer you are able to leave your money invested, the longer it has time to grow. If you invest $100 starting at the age of 20 and it earns maybe 8%, by the time you're 60, you'll have $300,000. If you wait until 40 to start, then you'll only have $100,000. So starting early is so, so important, even with small amounts. And a lot of people think that to invest, you need a lot of money, and you really don't. You could start with as little as $20 if you wanted, maybe even less, depending on what it is that you're buying. A lot of people will make an auto deposit into their accounts to invest. Sometimes it's $50, sometimes it's $100. And if you set it on auto pay or auto transfer, and you do that and you invest it every month, then you put yourself in a really great place because you're starting young. I wish I would have started young. I didn't start investing until I was probably in my mid 20s. Um, but if I could go back, I would have started when I was 18. It's just a really great thing to do. And the key is getting comfortable with it. If you do it once I always recommend to my students to start very small, and you start with something like $50, $100, and you put it in something called a brokerage account, which we'll talk about later on. But a brokerage account is basically like a bank account for buying stocks and bonds and things like that. So you put $100 in there, you buy something with it, and you just watch it over a course of like 3 months, 6 months. It's basically the same thing that you guys are all doing right now with the stock market challenge. You buy some kind of stock, some kind of position, and you just watch it grow. You watch how it moves, you watch how it responds to different things going on in the economy. And the key is getting comfortable with it. A lot of people think, oh, I'm going to deposit my money here and it's going to disappear. That's typically not the case. You see the value will change over time depending on the market and what's going on in the economy or in the country or in the world. And you can track it and you can see it. And once you get comfortable, then you can start putting in a little bit more. But I always recommend just getting it set up. That's the hardest part. Once it's there, it's so easy to manage, and then your focus should be, spent on trying to figure out what to invest in, right? What to put your money in. What are some good long-term growth targets, long-term growth positions that you could get. And you can Google it, you can search the internet for it, you can get baskets of stocks that represent a lot of different things in the market. But there's so many out there, and it's just a matter of you figuring out, what to pick. So the time value of money, the way you can think of it is a dollar today is worth more than the same dollar in the future. And so if you keep the cash under your mattress, for example, it literally loses value because it's worth more today than it would be 30 days from now, a year from now. And so the key is to put that money to work by investing it so that it can grow for you and ultimately get you that gain and maybe get you that investment income that you're looking for. So it has earnings potential through investment. And that's the takeaway from this concept of the time value of money. Now, when you're investing, you have to think about a couple things as it relates to who you are. But every single investment has a risk, and that's a really important thing for you all to understand. It could be the same thing, right? Crypto, speculative investments, which are considered, risky investments that aren't necessarily, that common. Then you have more of the safe ones, right? We put our money in our savings account. We know it's not going anywhere. It's insured by the federal government, but then you have something like a CD, which I'm sure, hopefully you guys have all heard of that, but it's an account where you deposit money and they ask you to leave it there for a specific amount, like maybe 3 months, 6 months, a year, 2 years. And depending on the length of time that you leave it there, it pays you an interest for doing that. And then you have government bonds, where the government basically pays you interest for letting, you buy a government bond. And let's say you buy $1,000 worth of a government bond. the government will then pay you for buying the bond or you're basically letting the government borrow your $1,000 and they're paying you interest on that. So every type of investment has a risk. And on one end, you've got the safe options, and on the other end, you have the very risky options. And you have to think about, what that comfort zone is for you. What is your risk tolerance? And that's something that you will figure out this week with the homework. But the rule of thumb is that basically the higher the risk, the more uh, the higher the chances that you'll get a really high return, but also bigger losses. You get rewarded for this risk return trade-off. You get rewarded for taking risk. And that's where you see all these people that take the risk of investing in these really, scary. For me, they're scary because I have a hard time with like crypto, for example. I personally I don't mess with crypto because I think it's a little bit too scary for me. But people that do, take that risk and win, they're getting rewarded for taking that risk. So there's potentially more return. So I gave you the example of the crypto. Some people were able to really double or triple or quadruple their money, but then there's also people that lost everything because they did take that risk. So it just depends what you're comfortable with, and think of it as kind of gambling. You are betting your money that this is going to pay off, and when you're putting in your entire family's, bank account, that's something that you really have to consider. If you're older, if you're putting all of your retirement savings into this type of investment that's very risky, then it's like, oh, well, are you comfortable with that? Your comfort level matters because if you invest in something that's risky and it loses, let's say you invest $100,000 and then you wake up tomorrow and that investment value has gone down to $50,000, how is that going to make you feel as an investor? If you're the kind of person that is going to panic and say, I lost everything, then you have to think about that risk profile that you might have. If you're the kind of person that's like, oh, I trust that it'll come back. I trust that it'll, rebound from this little tank in the market. So you have to wrestle with, okay, if you wake up tomorrow and your entire life savings is gone, how is that going to make you feel? Are you going to stay invested in the asset? Are you going to just want to sell everything and take the loss? And that's all, that's real. When I was at my investment firm during COVID, as many of you saw, it was a crazy time where the stock markets tanked completely. We had a lot of clients that panicked and they said, oh my God, the world's going to end. I need to sell all of my stocks because I'm scared that they're going to go down even more. And they wanted to sell. And we told them, that's what the market does. We've survived many different recessions, depressions. There's been many years of history with the stock market, and it does go through periods where it has very, very significant lows, but it always tends to rebound. And I think that was something that was hard for people to kind of, fathom, like to see their accounts go from a very high number to a maybe very low number, and they panicked and they wanted to sell everything. So they ended up selling and taking the losses, and then the stock market went up and they regretted it. And that was because of their risk profile. So your risk profile is a very important piece in this equation of determining what you want to have in your investment portfolio. You need to understand your own comfort level, and hopefully after completing the assignment, you will. So that's one of the most important pieces with safety and risk. So when you're choosing what investments you want to jump into, you have to consider safety and risk, income potential. How does it pay regularly? Like, does it have interest or dividends that it pays? Growth potential, can it increase in value over time? And then liquidity, how quickly you can turn it into cash. If you wanted to sell and pull out the money, how quickly can you do that? Typically, selling stocks is usually pretty fast. Selling a house can maybe take months, for example. So that matters in terms of, how you would want to invest. Obviously, like I'll give you some examples. Like I have real estate, but I also have stocks and I have bonds. And I also have government bonds. And for me, they all create income for me. My home, my rental home, they pay rent every month. That creates an income for me. And with my stocks and my bonds, I get the gain, right? If it goes up in value, I have a gain in my account. But I only have the gain when I decide to sell it. So the gain, I kind of look at it like I have a stock, it goes up and down every day. I don't pay attention to that, but it also pays me interest and dividends, mostly dividends. And those are basically income that's generated by the company and they pay all their shareholders. So I get a little bit of dividend income. And so I kind of focus on the dividend income, and then when I do decide to sell, I'm hopeful that there'll be a gain, but that gain is considered a capital gain. And then the dividends that I get every month or every year, over the course of the year, those are considered dividend income. And so you get different types of income. There's growth potential in the stock. There's growth potential in the real estate, right? If I sell my property one day, my hope is that it'll go up in value. And then I have both. So I diversified it so that if I do need to take out my money one day for an emergency, I can just sell the stocks and pull out my money. Whereas the real estate would take longer. And so I have it kind of spread out. And that's how I determine which investments to choose. So, something to think about as you're considering your own investment portfolio. Asset allocation and diversification. I just talked about how I put my money in different things, right? So I can have different risk, right, and different income potential. But the idea is that you never want to put all your eggs in one basket. And I really emphasize how the importance of this just by giving my own example. But it matters more than just, oh, you want to have like liquidity, convenience of liquidity, take being able to take out the money. It matters more than that. Every type of asset behaves differently when the market is doing a certain way. And so by mixing they call it asset allocation. And that's a very fancy word for just, it literally just means like what you have in your basket, what type of assets you have in your basket. Depends on the risk tolerance, but it also depends on, you know, how you want to, like your age, how you want to develop the portfolio to behave over time. And so for young people, for example, so stocks typically are very volatile. They go up and down significantly over time. Maybe the company announces their earnings. If you're Tesla, for example, Elon Musk starts tweeting about something, and then boom, the Tesla stock will go down or up depending on what he says. So there's different things that impact how stocks behave. Bonds are a little bit different. They typically react opposite of stocks, and then real estate is kind of like similar, I would say, to stocks, but typically it's driven by things like interest rates, housing, like if there's a housing surplus or a housing shortage, there's different things that impact each one. And so by diversifying it, if you have a stock that's maybe bringing you down because maybe you have a position that has, maybe it's a basket of stocks, maybe COVID is happening, right? And the stock market is tanking, but then bonds will tend to kind of stay at a certain level. And so it kind of helps you diversify your risk, and it helps your account kind of maintain like a decent balance despite what's going on in the economy. So they kind of act like a buffer. And it's important to spread that risk, to spread your investments over not only different asset classes, which is, a class would be stocks, bonds, real estate, but you also want to spread it over like industries and countries. And this is one of the reasons that I always recommend um, staying away from buying like a single stock in a company. Like if you're really wanting to buy Tesla, why not buy a basket of Tesla or electric vehicle stocks instead of a Tesla stock? That way, if something happens with Tesla, that means that other electric vehicle manufacturers will do really well because Tesla's customers are now coming to this other group of electric vehicle companies. And so instead of you tanking with the Tesla stock, if it tanks, you're now supported by these other companies that are doing really well and their prices are going up. And so you protect yourself from risk. When you invest in just one company, your risk really increases significantly because anything that happens with that company and your investments tank. And so you want to be careful with that. So I always recommend baskets of stocks, baskets of industry stocks, baskets of country stocks. It could be like the US stock market, the global stock market, and there's different baskets of stocks that represent that. You can just Google what is a position um, for US stocks that I can invest in. So you can look up different ones depending on what you're interested in. But you always, always, always want to diversify your asset allocation. You want to diversify what you invest in simply because it protects you against risk and it allows you to capture upside when things aren't going well for one party. They will be going well for another, and you want to catch that upside and keep your portfolio, you know, away from the potential of losing, everything or a significant portion of your investment. So that's a really important concept as well. And so the next slide here, I have just a quick overview of popular investments. I've gone through a lot of these, I think, by now, but so stocks give you ownership in a company. These are the ones that you have all selected for the stock market challenge. And at any time, you are welcome to go in and sell and buy different things, depending on if you want to do that, or you can just stick with your investments. But it's neat to see how they react, especially like, if something big happens, like if there's a new election coming or if the government might shut down or, big things like that that happen, it will impact how the stock market behaves. And then we have bonds. So bonds again are loans that you're basically letting someone borrow your money. It could be the government or a company, and they give you interest for doing that. That's why they tend to be a little bit less volatile. And then you have mutual funds and ETFs. These are those baskets of stocks. These are great for beginners because they bundle a bunch of investments into one, giving you that diversification. And then you have real estate. This can provide rental income, or you can increase the value and gain over the course of maybe 10 years, et cetera. It should be considered like a long-term investment because um, typically it appreciates and goes up in value over time. So there's real estate. But again, as we learned in the previous chapter, it requires more money, more maintenance, and all that. And then finally, there's something called speculative investments, which are things like crypto, commodities, or collectibles, like art. These are risky and they should be approached carefully. So if you are a beginner, personally, I would start with, these other like bundles of investments and get your feet wet. And until you have like a better, like you're in a place where your balance is, your budget is balanced, you have all your debt paid off, you're, in a place where you're making regular income, you have your emergency fund set up. Think of that, remember that A, B, and C portfolio. This should be that C portfolio. You want to, if you want to play around with this portfolio, you can, but just be sure that you take the time, to understand what percentage of your budget you're actually dedicating to this and making sure that you understand how risky it can be and that while there's a risk reward ratio, meaning that you do get rewarded for taking risk, you could also have a bigger downside in that you could lose everything, and you want to be aware of that and make sure that what you're investing in that portfolio doesn't take your family over the edge in terms of losing everything. Okay. Let's see. So as an investor, some important things. It's not just about picking something and forgetting about it forever. You need to stay informed. You need to monitor your investments. You want to keep records and seek professional advice if you need it. It's something that we're not taught in school, so it's a new thing that we're learning from scratch. So I encourage you to go online. There's tons of resources out there on investing and just investing responsibly and just kind of building that framework. The more you educate yourself, the better you'll understand everything and the easier it will be for you to do all of this. But you want to be careful who you get your professional advice from. Like I said, there's a ton of social media personalities that they gain followers by trying to tell people how to invest, and they're not qualified. And you want to make sure that whoever you're getting your advice from, make sure that you do a little background check on them, Google them, look at their credentials. You can look up any investment advisor online You can just Google, look up an investment advisor, look up an individual. There's an SEC website, there's a California website as well where you can look all these people up. But make sure that you don't just take advice from anyone. You want to stay informed and read the news and kind of read about things going on. I love Yahoo Finance. It's free. They have an app and they do a really good job of giving you kind of the news that you need to know. And I like that particular platform for looking up stocks, looking up news about that stock, looking up particular investment classes, or maybe there's a particular type of investment that you want to learn more about. And Yahoo is a really great resource. I highly recommend that one. But do your homework. And then you don't want to be that person that like checks their stock prices every hour, but definitely pay attention, try to monitor it regularly, not every day, but every now and then check into your investments, and you want to keep your records, you want to track your goals and make sure that you're going and where you want to go. If your investments are growing, you want to see that. Not only is it good to monitor it, but it's also good for keeping you motivated, right? To continue investing and to see that your investments are actually paying off. That's a good thing to do. And then if you ever need professional advice, there's financial planners, there's investment advisors that you can reach out to. But at the end of the day, no one cares more about your money than you. So you want to be your money's advocate. You want to be your own advocate, and you want to be an active participant in this process. So just want to emphasize that social media piece, because there are so many. I follow some of them myself, like I mentioned, and some of them are say things, and I'm like, where? Like I know that that's not accurate, because of my background and my education, but a lot of people wouldn't know that. So I think it's dangerous to just trust anyone online. I think that's the big takeaway. So some sources, like I said, Yahoo Finance, there's something called Morningstar. They have summaries of all the different positions. There's lots of apps. There's obviously news, there's government publications, corporate reports, and then financial advisors. So tons of information out there, online tools. There's Robinhood is a great app, Vanguard. I like Robinhood because it's more like, hip and modern. They also have it's called Robinhood Snacks, and it's like a little news article that they send every now and then. And I really like that because it summarizes kind of what's going on in finance in a really fun way. So if you can, I encourage you to sign up for that newsletter. It kind of has like a funny, like fun twist to all the like finance news, and it puts it in, I think, a language that we find easy to digest. And that's their point, that they want to make that news and those articles easy to digest for normal people that aren't necessarily in investing or finance. And so that they do a really good job of that. Business news sites and periodicals will talk about different trends, and those are good for you to know so you can, make decisions accordingly as it relates to your investments. And then the government agencies like the SEC and the IRS, they publish reports on different things, and those are always meant to like protect you as a consumer and give you the information that matters. And then financial advisors, just make sure you find one that is something called a fiduciary, and that you make sure that you do a background check on them and make sure that they do have your best interest at heart. All right. So putting it all together. So how do you actually start? So again, get your finances in order, have your debt paid off, balance your budget, set your emergency fund, and then have goals. That's a really important piece, right? Like everything else, you want to know where you're going. If your goal is retirement, if your goal is to save for a house, if your goal is to start your college fund for your child, whatever those goals are, you need to make sure that those are clear so you know where you're going. Then you have to figure out what is your risk tolerance. You have to decide on your comfort level. And then you decide where your investments are going to be going, where your money is going to be invested, that asset allocation that we talked about, how you're going to diversify your investments. And then once you actually invest and you stay informed and adjust over time, for those of you that start young, for example, it's okay to have more risk in your account, meaning more stocks. Stocks tend to be riskier than bonds. And so you would have like a little bit more stocks and fewer bonds. But then as you get closer to retirement, you would want that to switch, and you would have more of the bonds in your account and less of the stocks just because they're less risky and you want to get close to being in a place where you can actually take your money out. So there's different types of portfolios that you can have. Like I've seen 80% stocks, 20% bonds. I've seen 60% stocks, 40% bonds, 50-50. It just depends on where you are in that timeline. So key takeaways, the best time to plant a tree was 20 years ago. The second best time is now, and meaning it is never too late to start investing. Obviously, I talked about wanting to have started earlier, but I didn't start earlier. I started in my like mid to late 20s, and I am so glad that I did. It's never too late. And the key is just starting and starting small, because if you start and want to just put a lot of money down, it's scary. But if you start small, you'll see how your investment behaves over time. And that makes you grow comfort in putting your money in this particular type of account, which is a brokerage account. Think about the first time you deposited money into your checking account, right? It's like it disappears going into this digital space. But that's how brokerages are. And the more you monitor it, even if you did like $20, you watch it, you see how it behaves, and then you think, get a little more comfortable, maybe put another $20, etc. You can start small and you can start now. And maybe you decide not to go to the movies and spend that $20, $40 and put that money into an investment account and see what happens, right? So start small, stay consistent, and think long term. Investing is not about timing the market. A lot of people think that they can time the market, but it's not possible. It's been proven over time. It's about spending time in the market rather than timing the market. So the strategy should be patience, long term, that building wealth over time perspective over your lifetime. So I hope this gives you a good framework to dive into the chapter and a good framework as we move into the next chapters on stocks, bonds, and other types of investments. So that is it for today. Thank you.